I'm Charlotte McLeod with investingnews.com, and here today with me is Don Hansen. Don is a private investor who's been investing in the gold and silver mining industry for more than 20 years. I think many people in our audience will be familiar with Don because we've done a number of interviews over the past year focusing on his strategies for evaluating gold and silver stocks, as well as building a portfolio. For this interview today, we're going to build on a couple of interviews that we've done recently. So we're going to start by going over some information covered previously, and then we'll get into some new data from Don on gold stocks. So I will share my screen. Bear with me for a moment while I do that. And if you can just prompt me to move to the next one when it's time.
Okay. I wanted to start this particular interview by reviewing a couple of things that I did in the two previous interviews with you. And let's start with, and what I was looking for in this first one was the relationship between gold and the S&P 500. And so what we're going to look at here is the S&P 500 from 1972 to 2000. And what this is defining is basically a cycle from bear to bull. As you can see, the first 18 years was basically a bear market for the S&P 500. It basically ended about where it started. That's why there's 0% on the other side. And then the second phase, of course, was a bull phase where it was up 220% for 10 years. One other comment I would like to make about this is, and I don't show this, but there was another cycle almost identical to it that went from 1945 to 1972, 27 years. Of course, I didn't really get into it because there was no gold price change all those years. It was $35 an ounce. It was a straight line. But the interesting thing about that was that cycle's 27 years, about 17 years worth of a bear for the S&P, and then a 10-year from about 1962 to 72 was a bull market. And so we have, I think, more credibility for the fact that there really is this 25 to 27 year cycle that's going on with the S&P. And we're now, and when you turn up the next one on the S&P, the next slide, you'll see that we're almost at the end of the third cycle. This one starting in 2000, and now, of course, it's 2024, so we've got a cycle that went to 2014, again, where we got back to where we started on an inflation-adjusted basis, remember. And then the bull phase, of course, goes from 2014 to 2024 now, and it shows a 93% increase. That actually, if we would update that to April, the increase would be something like 100%, but a lot less than the bull phase for the previous cycle. If you remember, in the earlier one, it showed a 220% increase for that bull phase, and only about 100% here. And the reason for that is that the GDP was growing in the U.S. in the 1990s very rapidly. We had like 5% or 5 or 6% a year GDP growth. And so naturally, you would have a greater growth in profits and sales and everything for the S&P 500 stocks. In this last bull cycle, the GDP growth was like 2% or less. And there's a significant reason for that we'll get into subsequently. But let's look at the gold ones, because I'm gearing all the cycles based against the S&P, because it's the master cycle. It's an enormous market versus the gold market. Gold market is just responding to it. So, but let's look at the gold as well. And here we have the opposite of the S&P for that first 18 years. Gold was up 187, but down in the last 10 years at a negative 47. Then let's look at the next one. And there is the 2000 to 214. We see that the gold was up within a bull phase, is up 179. And interestingly enough, even in its bear phase, when you compare it to the S&P, was up some. And so you would say, well, gee, why is that the bear phase for gold was a negative in the first cycle, but a positive in this cycle? And there's a very simple explanation for that. Prior to 2010, between 1990 and 2010, the world's central banks were selling gold every year. Starting at around 2010, they started to buy every year. And in the last 2 years, 22 and 23, they increased their buying by 100%. They went from 500 tons a year to 1,100 tons a year. So that's the reason why, even in what we would call a bear phase, because it was alternating with the bull phase of the S&P, it still was up anyway because of that factor. And there's another interesting one here to look at. The gold phase, actually high and low, is a little offset from the S&P, which is not a surprise. But if you look at the January 2012, and you'll see that the peak of that cycle was 2360, and where we are right now in April is about 2350. So it's and the way these cycles tend to work is that you're in a bear phase until the variable, whichever one it is, gets back to where the previous peak was. And that seems to be the trigger point. Then the market says, oh, we're off to the races again. And so we are like right now at that point. So I thought that was interesting as well. So then the other thing that I was thinking about as I'm looking at all this is saying, gee, the price of S&P 500 is going up. The gold is going up. What's the U.S. dollar doing? Because they're both denominated in dollars. So that's what we're looking at. So then we'll go to the next set of slides. This is probably the most important slide I'm going to show anybody today. And that is that we have the U.S. money supply, the M2, is plotted against time all the way from 1970 into, 2022 was my last number. But the interesting thing is how clearly the growth follows the, exponential growth curve. And that's a really big deal. And it's a big deal for a lot of different reasons, but it seems to be inexorable. It's just going to keep going up, and it's now starting to approach the point where it's going vertical. And let's see the next slide, then you'll see something else that also looks interesting too. What I did in this slide was I plotted the U.S. debt alongside of it, and you can see how it tracks perfectly. So what we're looking at then is that the U.S. debt has pretty much been financed by printing all the money. I mean, they track right on, and we know that the U.S. debt is growing at a very rapid level now. In fact, over the last 10 years, from 2014 to 2024, the U.S. debt in 2014 was 17 trillion, and in 2024, it's actually almost 35. So it has gone up double in 10 years, what it took 200 years to get to in the beginning. So obviously the debt is going exponential, and is as the money supply doing the same, because that's how they pay for it. So that's a really important thing to understand. It's also the reason why the GDP growth was low. In the most recent bull market for S&P, and much higher in the 90s for the S&P, because the level of debt is so high. And what economists have learned is that as the debt gets higher, economic growth gets more difficult. And when the debt to GDP ratio gets over 100%, which it is well over now, then it becomes really difficult to get economic growth. So that all fits in terms of, okay, why was that growth so much different? It's because the debt level has been so much different in the last decade. And then one more slide, which it finalizes kind of what we're looking at here, is I plotted then gold against the money supply. And it's fascinating to see how, although the gold was kind of higher and lower at different points than the money supply curve, back in the recent decade, if you can see, like 2015 would be the plot there, where the gold and the money supply are very close. And then the next two postings are almost identical. So for some reason, the market has had the gold and the money supply tracking right on the money supply curve. So what that tells me is we should expect that the gold price is going to go up, and it's going to go up faster and faster because it's an exponential curve. So that was the context I wanted to start with as we then get into what I wanted to discuss today, which is the gold mining shares, which we haven't talked about yet.
Okay, thank you so much for doing that. I think that takes us through our review of information, and that helps set the foundation for what we're going to look at moving forward. So we'll now move on to looking at your new data focusing on gold stocks.
So here we go with this slide. And what I was interested in doing is relating again to gold, as I'm doing it in all of this data. And the HUI is the gold bugs, so-called gold bugs index. It was started back in 1996, and it's 100% gold miners, and they're all the bigger ones. And what you see in the data that I'm showing there, during the bull market in gold in the early part of the century, we had an average on that ratio about 2.3. Then in 2010, but it started to go up, and then in 2016 we really got up. So that number's a little off. But anyhow, the bull phase, of course, with gold got started in the 2016 period, and then more recently we're in the neighborhood of 8 and 8.5. And with an average over 2014 to 2023 of 7.4, so 3 times. So what happened, of course, here is that we got into a bear phase for gold, and the mining stocks were not keeping up with the gold price because of cost increases and also, and I think quite significantly, the multiple of earnings was much lower. And then that's normal. In bull phases, the multiple of earnings is much higher than average, and in the bear phases, it's much lower than average. For the S&P, for example, one of the reasons why we think that the bull phase in the S&P is about ending is because the multiple of earnings is over 25, with a long-run average of 17. And if you look at the bear phases in the S&P, it would be down around 10 when it's in the lowest point. So we think that then the multiple on the gold mining stocks is well below the long run average. So they're just inverted like they have on the rest of the cycles. But the interesting thing then is I'm looking at the another way of evaluating the profitability of the gold miners to compare it to what we're seeing above. And I'm doing that using the gross margin, which you've seen me do before, Charlotte, which is, I like to do that because the all-in sustaining cost is abundantly available in all the data on the mining stocks. They always have that in their corporate presentations and everything. It's very easy to get it, and it's a pretty good number. The only thing it doesn't include in costs is G&A and taxes, but that isn't necessary, and I don't need to know all that. And I've been using that for some time, and it's a good way to get this gross margin, which has told me a lot about trends and even the degree of trends over the years. So I like to use that. So what I'm doing here is calculating the gross margin using the all-in sustaining cost and as a percentage of the gold price. And so in the bull market phase in the 2000s to 2010, we had that calculating around 50%. Well, then we got down into the bear phase where the gold price was down and that cost had gone up, and we saw that got all the way down to actually 20%, they are way down. Then we get back into the current time, and we can see that the gross margin has improved, and now as of April 2024, it's actually 43% of the gross margin, and yet the ratio between gold and the HUI is still high. It's, in fact, in April here, it's like 8.5 or thereabouts. So I'm asking myself, why is that? Because that doesn't make sense. And part of it is, I'm sure, because of the fact that the multiple of earnings in a bear phase is much, much lower than it is in a bull phase. And so that it probably explains most of it. There's some issues with the cost, but the cost in terms of all the sustaining costs in the recent years has been around $1,300 an ounce. There's certainly some companies that are much higher than that, but I don't follow those anyhow because I'm not interested in the high cost producers. I'm fond of the ones that are on the low cost side for a lot of reasons. One of which is if times get tough, they will survive and the others won't. So anyhow, there's obviously something there. I think is a mispricing, which will be explained as we go along with the fact that we get into a new bull market in gold, and that should change so that there's a potential to see a substantial increase in the gold shares, gold mining shares, when we get it into a gold bull market phase. So, yeah, I think we can see then when you go all the way from 8.5 to 2.5, that's going to be a big shift. Okay, then once I came up with that part of it, I'm thinking, well, there's certainly an opportunity for substantial profit if that occurs, which I believe that it will, because it always seems to when you change from bear to bull phase. So then I did something else. That's what we can look at the next slide, where I just said, okay, how would I recommend and how do I practice the buying and selling of gold mining shares based on the cycles that they tend to follow? And so this Mr. Pierre Lassonde came up with this cycle many years ago. He was the founder of Franco-Nevada, which was the first royalty company in the gold mining space and a legend in the industry. And his cycle really ended where I have D. And I extended that because of what I like to do in terms of investing, that I'm looking to find companies that actually are going to move it up to the E level, and he doesn't cover that. Most everybody is just talking about the first part of it that gets up to the D level. And so I'll talk about that. And one of the things that I'm showing there is that there's about a 15-year cycle that goes from where the explorer first is starting to drill holes and find gold in the ground to where they're actually producing it is approximately 15 years on average for resource companies. That's a long time. Sometimes it's shorter, sometimes it's longer, depending on the project, on the location, on the conditions in the market and the availability of funding and all that kind of stuff. But over the long run, all the experts in resource tell me that, yeah, it takes about 15 years when you start from scratch. So that's my timing on that. And what I'm looking at over here, if we look at an exploration company that's trying to find gold, has no revenue, I think that a good place, if you can find one that has a good management and a good location and all that, and has the prospects to do well, if you can buy it at a point, then that's a great time because you want to ride it up. And the peak part is when, okay, they have found what they're going to find, and they're ready to do the engineering studies and raise the money and all that sort of stuff. And that is the period where you want to try to sell at B before it gets into what they call the valley of the Lassonde Curve. That is where, as an investor, you do not want to be. And that can last for 3 or 4 years in some instances. Sometimes takes a long time to do the financing and to do the permitting and then the staffing. In fact, the staffing is a much bigger problem today than most people realize. Over the last decade, because the gold market has been in a bear phase, a lot of geologists and mining engineers got laid off, they retired, they got a job in something else. And during that period of time, in fact, very few young people studied mining engineering and geology. So now that we're starting another bull phase, we think, in resources of all kinds, including gold and silver, there's a shortage of such people. And that's a big issue that nobody talks about very much. But anyhow, then if they get to where they have gotten the permitting and financing and staffing going, and it really looks good, then the investor would want to buy somewhere in that C range where it's now starting to go up. But most of it's been de-risked, as they say. And so that's a good time if you believe they're going to get to that first plateau. And then if you say they got there and the price is probably going to stabilize to some extent, then the question is there a company that has the potential to expand up to the next plateau? And some do, and not very many, though. And then those are the ones that I like. And so I'm going to talk about those and my recommendations because those are ones that I think can get up to that other plateau. And so we'll look at the next information then. What I'm showing here is as I mentioned, the buying at point A and selling at B and so forth. The criteria, of course, is that buying at A, you want management, jurisdiction, and the ability to raise money, which is probably the most important one, because they're going to have to raise money for a long time before they get into production. They're going to be raising money for exploration and staffing and everything. And then, of course, the other part is infrastructure and labor availability. You don't want to be in a location where you don't have power or water or all these other kinds of things. And then the other thing you'd like is for this project to have size potential so that the bigger miners might actually want to acquire it if this people that are doing this exploration are not experts in building and operating mines. They're two different skill sets. So then if you buy at point C, of course, again, we're always looking at financing, our management, but then we've got the financing completed, permitting completed, and staffing in place. Then we're ready to go. Then at D, again, it's in profitable production, but we have a significant production increase from the initial mine capacity to get us to that next plateau. Okay, here is the companies that I like and that I have my money invested in, and I'm just pointing out where I bought them. K92 and Aris I bought where they were already in production and doing profitably well. Minera Alamos and Rio 2 are not fully underway there, but I like them a lot because of the management. Both of them have management that has been highly successful at doing the same thing they're trying to do now. So they know what they're doing. They've made the mistakes and all that. And I'm very confident that they will be able to pull it off. In terms of Aris, they actually, in terms of management, have the most extraordinary management team you could imagine. And the CEO is a man named Ian Telfer. I know you would have heard of him. And the CEO is a man named Neil Woodyer. Those two, plus a man named Frank Justra, over 20 years ago, started a company called Wheaton River. That evolved into two companies that were highly successful, one being the Silver Wheaton, which was the streaming company, and the other being Goldcorp, which was one of the most successful mining companies in the past 20 years. And Ian Telfer was the CEO of that. So these two are just phenomenal, and they've been through it all. They both are 80 years old, but I'm not concerned about that because they have the ability to find really good people, and the really good people want to work for them because of what they can learn. And so they're able to hire the very best and raising money. They probably both billionaires already anyway, but so that's not even remotely an issue. So I like that one a lot. And K92 as well is an excellent company that is operating in Papua New Guinea, which is actually formerly a part of Australia, an English-speaking country, 95% Christian, other mining projects there, and it's a very high-grade mine. All its sustaining cost in there is only $800 an ounce, whereas Aris and all these other people that I'm on this list are closer to $1,200. So a really extraordinary company. So those are my personal favorites in the gold mining sector, but I like them because they have this extra opportunity to increase your share value when they take that next step to get up to the third level, the second level there, I should say. So, so the reasons why these companies can achieve significant increase in value, the production increase, which I'm saying here, could get 3 times the multiple of earnings that we showed on slide 3, potentially could be 3 times. A gold price increase of 50%. It went from $2,400 now to $3,600 in 2 years. That would increase the gold price by 50%, but the gross margin by 100%. So at 2 times. And then I like them because I feel like the risk is relatively low, especially for the interest issues such as financing, permitting, and staffing, which is the bugaboo of all the companies in the valley of the Lassonde Curve. That isn't there anymore. So there's always risks in mining, but I think relatively low, and considering the potential that they have. So that ends up being a lot of multiples. You add it all up, it's like 8 times. So there's a lot of reasons to believe that this is a great time to be investing in mining stocks, gold mining stocks in particular. Now here, I wanted to study where we were in terms of the current situation with the market caps and gross margins. And so what I did, I've got the market caps for each of the companies plus another one for comparisons purposes. And then I figured the gross margin based on their expansions. That's what they were, where it would be in 2026 if everything goes according to plan. And then I calculate basically a multiple of earnings using the market cap divided by the gross margin. And you can see that in the first two, it's only 2.4. In the other smaller companies, it's much lower than that at 1.7, 1.8. But the thing that I wanted to emphasize here is Alamos is a great gold mining company, and they are operating at a high level of down below, you'll see 540,000 ounces of gold per year. But they've been there for a while. They're right stable, and the market loves them. And the multiple there is 10. Well, then you say, oh, gee, if K92 and Aris do what I think they're going to do, they should get the respect that Alamos gets by that time. And then you could see 3 or 4 times multiple in their share price. Now, in Rio 2 and Minera, it could be even greater, but they may not be as high in 2026. But I still see them substantial growth potential. And you can see in the bottom there what the forecasted production would be. The Alamos is 540, but K92 and Aris are 400. And so they should be somewhere in the ballpark. But the multiple thing, it doesn't need to be 540. It's just a multiple of the gross margin. The gross margin is more because they produce more. But in terms of being in that category, I should think that K92 and Aris would be able to do that. The Rio 2 and Minera are smaller, but their gross margin would still grow and be if it is what it showed there, then if it got even a 7 multiple, it would still be 4 times for them. So that's why I like these 4 companies. And I thought it was useful just to see, well, what does the rest of the market do with somebody that produces 500,000 ounces of gold? And Alamos is a good candidate for that, just to give viewers an idea of, well, okay, relative to what? And I think that's a good comparison to consider.
That was great. I always love how you set the stage for what we're going to talk about and then give us the data and this time some actionable information that people can really use, I think, to hopefully start organizing their portfolios. So once again, thank you so much for going through this. This was really helpful. Was there any other points that you wanted to cover?
Yes, I would like to kind of summarize what I've done over these last 3 interviews, which is that I'm very confident that we are about at the end of one of those grand cycles, of which would be the third one here in the S&P 500, and that when that happens, then we're going to go into another bull phase, and that is going to result in major increases in the mining shares, which I've noted. And that was, once they get into mining phase, then the multiples get higher, and of course if you buy the right ones that have the option of increasing their production in near 2 years or 3 years, whatever, something like that, then you're going to make a lot of money. In other words, what I'm trying to get across is that this is a special time in history that comes around once a generation. It happened back in 2002 or 3, and for me, I was very fortunate, and that's when I started to follow silver in particular and gold. And I invested heavily in that, especially silver, and it made a lot of money. And for me, and it allowed me to basically live very well without a paycheck for 22 years. And so what I'm saying to viewers is, this is an opportunity for you, particularly if you sell your stocks and then put your money in gold and gold miners, that you have an opportunity to make life-changing profits for yourself. Because I did it, and I lived through that. I made some mistakes, but it's a good point to start if you aren't already doing it, because it can make an enormous difference in your life. And I hope that people will take advantage of that, because that's why I like doing this kind of thing, is to hopefully help other people. Because as you know, I don't get paid to do this. I'm not selling anything. I'm just trying to share what I've learned over the last 20 some years, so that people can hopefully make good money, protect themselves in view of things getting really difficult by owning gold bullion. And also, just to summarize, I tend to hold about 1/3 in gold and silver bullion and 2/3 in the mining stocks at a point like this. And in terms of the mining stocks, I do about 2/3 gold and 1/3 silver. Silver will go up because it always does during a gold bull market, but it's more volatile, and I would even tend to sell some of that, whereas I would never sell my gold bullion. I consider that to be family wealth that should be held for a serious emergency of whatever it might be. Besides, that's what gold has been used for thousands of years, as family wealth that is there if there's serious issues that the family needs, that they can get through and survive and prosper. So anyway.
Okay, I think that's a perfect summary of all the concepts we've been going through. And as you mentioned, we've talked about these topics in previous interviews. So as I usually do, I'll include the links to the previous ones in the video description so that people can hopefully go back and watch them. And of course, thank you for me for going through all of this information. I find it really helpful. And I think I can also speak for the viewers who I believe are also finding all of this helpful. So thank you once again, Don.
You're very welcome. Thank you. You've been great to work with. I really enjoyed it.
Oh, well, we'll have you back on at some point in the future. I know you're always looking for new topics, so
Yep.
we'll continue that. Perfect. I will definitely look forward to seeing you then. And once again, I'm Charlotte McLeod with investingnews.com, and this is Don Hansen. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.